Well, good evening, everybody, and welcome to our 10th anniversary celebration of the Investing Roundtable. Yes, we started this back in July 2010, and you'll be hearing tonight from my dear friends, Ken Kavula from mid-Michigan, Lynch from Atlanta, Hugh McManus from Pasadena, and Kim will be our guest damsel tonight. She's operating out of Florida, probably in air conditioning because she found some, but by way of Evansville, Indiana. My name is Mark Robertson. I'm founder and managing partner of Manifest Investing, and we are just delighted to be here with you, and we want to acknowledge the contributions over the years of people like Herb Lemcool, Susan Maciolek, Ann Manning, Matt Spielman, Nick Stratigos, and last but certainly not least, some of the technical support we've had over the years from our producers, Dan Horinek and Kowitz. So let's go ahead and get underway. Yeah, those are just a bunch of cover slides. I could have found 100 more, I swear, that would work for this. And let's just go ahead and get started and have some fun. Here's a standard disclaimer. If you've been with us all along the way, you know the way this drill works. No recommendation is intended whatsoever. This is an educational demonstration. It's for illustrative purposes only. And we're basically here showing how and sharing the methods and philosophies and techniques of the modern investment club movement as championed by NAIC, Better Investing, or as promulgated by Manifest Investing. They are our views, and we may actually own some of these things that we talk about. We generally remember to admit that when it's the case. If you'd like to be added to an email reminder list for this event and other educational events that we do, please send an email to nkavula1@comcast.net. For copies of the slides or for any follow-up questions, send an email to markr@manifestinvesting.com. All right, here's our agenda. It is literally the same in general format and feel since July 2010, 10 years ago. We'll start with an introduction. Again, welcome if you are joining us for the first time. We do keep these fairly informal over the years. We do take verbal comments. You can also input comments or questions into the questions box, and we'll have somebody monitoring them. But just a big welcome if you're here joining us for the first time. We'll talk about our performance results as part of this. We do keep score with what we do. We'll talk about this notion of we do have hot seat stocks that are in a challenge position in our tracking portfolio. We won't spend much time on that tonight. We have been doing considerable house cleaning over the last several months as we demonstrate some selling methodologies. You can see the 5 ticker symbols that are there that we'll be going over tonight and making individual presentations. So obviously we've got a lot ahead of us. There's an audience poll at the end. Again, anybody here, even if you're here for the first time, are welcome to participate in that poll. And we do leave time most evenings. I'm not sure we'll have time tonight, but if we do, there will be an opening for Q&A. So what's the best thing for being sad? Young King Arthur. And we got to love the quote, the best thing for being sad is to learn something, especially when you can do it with a group of friends. This introduction basically is the same one that's been in place for 10 years. We are just simply here to share a single idea, an actionable investment opportunity, and we do try to invest in a blend of companies. We do welcome non-core selections. We see them probably most often from Hugh McManus, and we love and cherish those. And our objective is to basically put together a tracking portfolio that beats the Wilshire 5000 by 5 percentage points. And we'll check in and let you know how we're doing. We do like to see about half, maybe a little bit more than half of our selections outperform that index, that total stock market index over time. All right, so no costumes. Going back to July 2010, I had asked Ken if he'd be interested in doing this sort of thing. And he says, well, no costumes, I'm in. Those words actually launched a program centered on the sharing of ideas among friends. Not just any friends, we call them super investors. We're not just talking about investing. We're collectively grateful for the lessons of George Nicholson and his urging, his nudges, that we can discover opportunity. invest in a blend of faster growing small companies, medium-sized workhorses, and the larger blue chips. We know to focus our attention on a few critical key factors in anything that represents an opportunity or a challenge. This group of friends have established track records in our annual stock selection contests, group and individual. Their experience base here is broad, from an engineer turned lawyer turned preacher, to a pharmaceutical scientist, to a couple of retired healthcare professionals with things like labor and delivery on their resumes. We're grateful for contributions from groups from places like Janesville, Wisconsin, to a business manager and his investing colleagues in Pittsburgh. Our hearts go out to you all. Others are perennial stock contest leaderboard residents, hailing from places like Houston. Still others champion investment education, execute entrepreneurial careers, and serve as things like the grand poobah of the Cherry Festival in places like Traverse City, Michigan. Holidays are special to us. From Halloween and our annual trick-or-treat quest for the best small, faster-growing companies, to the red carpet gala that we hold every February right around Oscar time, when we distribute our own Golden Knight statues. We speak of and celebrate rhinos, one-hit wonders, Atlanta Braves, white knuckles, and a commitment to the power of demonstration. No costumes, so we resort to cyber hats and ooze gratitude with our Thanksgiving celebrations. St. Patrick's Day, you bet, we raise a glass and toss some green food color in a river. We celebrate collective achievement here, and we spend suitable time hovering over or near glowing fireplaces during Michigan winters. The themes flow naturally, from dragons to campfires to avoiding the wrong end of a spear to mammoths and Vulcan investing. More on that here in a minute. Our portfolios continuously seek a few good horses and cherish the wisdom of hunting in crowds, the discovery of ideas, a nod to the things that really matter. From an engineer turned consultant turned magazine editor turned analyst and investing advocate to a professional educator who's equally comfortable guiding a calculus or algebra student, negotiating with or for teachers, perhaps our greatest resource, to producing a student drama or calling a football game. It's a diverse group that we call our friends. Thank you, Ken. Thank you all. And with that, what I thought we might do is spend a few moments sharing some of our favorite moments. We talked about one this afternoon. And I think, Ken, you can take this one away.
Well, this is my hogs, my dead pig bounce, as Mark has labeled it. One of the earliest stocks that I picked to go into the roundtable, and I think I did a really nice job on presenting it to the group. We talked about the Chinese eating more pork per capita than any other people in the entire world. I thought that my family was a really close second, however, growing up in a very Eastern European household where there was pig in almost everything and where all parts of the pig were cherished and eaten with gusto. I found a company, a Chinese company with the ticker HOGS, H-O-G-S. I suggested we buy some stock in it. It had a beautiful visual analysis on the SSG. It kept saying buy, and in fact, we did buy it 3 or 4 different times in the early stages of the roundtable. And then one day, rumors started to circulate that this company wasn't really a company, even though it was listed on the New York Stock Exchange. We did some research. I did a lot of research because I was really embarrassed about presenting a non-entity to something in front of a live audience. And it turns out that this company never really existed. The pictures on their website were indeed real buildings, but they had nothing to do with any kind of company that sold pork products or that did pork processing. Turns out the whole big idea was one big scheme They were taking the money from the investment and lining somebody's pocket with it out offshore United States. And eventually the stock, while still being listed, dwindled down to pennies on the dollar, actually fractions of pennies on the dollar, and eventually just disappeared. I still think it's probably our one and only stock that we actually had disappear by leaving the scene of the crime without giving us any benefit of any kind. Go on, Mark.
Ken, let me take you out of the off the floor here. We actually did sell it for a positive balance, because remember, there was a rumor that they were trying to take this company private, and it pushed the stock price up. So we got out at a reasonably small loss, all things considered. And I'd also point out,
I'm so glad I don't have survivor's guilt then. All right.
And I selected this company once too, and actually made a positive gain on it. And even more than that, we picked your story in this presentation for one of our golden statues back in one of the first years of the Roundtable. So I
you're
think
not getting the statue back. So okay.
No, you get to keep the statue, and
okay.
I get to keep his Braves uniform, and Hugh gets to keep his hat. We all get to do those things. I thought we'd stop in on what I think is one of the greatest moments, and I'd invite Hugh to share his thoughts about this one. If you have not listened in on Hugh's presentation on this subject matter, and I'll just call it the campfire speech, you can read about it on that first link, and you can actually listen into it, thanks to Dan Horinek at that YouTube link that's actually shown on the page. But Hugh, this is one that we've heard a lot about over the years. Any updates to it?
Okay, can you hear me all right?
Yeah, I can hear you just fine.
Okay, yeah, I just switched to a phone. No, I just observed many years ago that, working with NAIC, it was called Better Investing today, during the 90s, etc., and then working in California in the early part of the 2000s, how irrational people really are when it comes to investing, and me included, quite frankly. And so I tried to sum it up by saying when it comes to investing, there should be more Spock and less Kirk. I think psychologically as an animal, we are built to fail as investors. We do the wrong things at the wrong time. You can see the picture up on the top right. The reason is that good events evolutionarily, or from an evolutionary perspective, are very rare. I mean, look, if you look down at your waist, a couple of you anyway, well, me anyway, you could see there might be 1 or 2 extra ounces of fat sitting there. It's a maladaptation. We have a craving to eat fat because it used to be so rare. You can see the picture on the top right. Felling a mammoth or an elephant like that was an extremely rare event, but fat has a lot of calories in it. We go crazy for it. And today we go crazy for it still. That programming is there. We eat too much of what we shouldn't eat, fat, sugar, etc. And I thought, well, that maladaptation exists for just a whole host of things in the human race. In religion, we often call it sin. But if you think everything sin is an evolutionary maladaptation at its heart, then why doesn't it not work for investing too? And it doesn't. I mean, we are, as an animal, not optimized for investing. We sell when we should be buying. We buy when we should be selling. And we take comfort of the wrong things. It's very tough as a social animal to buy something that no one else wants and feel lonely there. Just thousands of impulses in your body saying, don't do this, don't do this. And yet when we're buying the wrong thing,
I was just going to say, fear is a tremendous agitator when it comes to investing.
It's stunning. And we saw in March, fear has an on switch. I mean, it just propagates through the species almost instantaneously. But a rational response, wow, that has a delayed timer on it. It just takes forever for people to do the right thing.
Yep. Well, one thing I went and I actually listened to that presentation again today, Hugh, and I don't know if you remember, but I got to thinking, all right, I was waiting for you to turn in your stock selection for tonight, and I got to think, I said, well, what is Hugh going to loathe tonight? What investment opportunity is out there that we're all holding our nose and I had it almost right. With you bringing BP, I don't know if you remember this, but you featured the oil patch and a really nasty situation at the time back then also.
Oh yeah, Deepwater Horizon. It was polluting the Gulf.
Yeah.
It was the end of the company. All analysts were saying that. They were projecting quite rationally and reasonably, and I was buying into it. This company won't exist in 2 years after it pays off the trillions of dollars that it owes various governments and fish and some aquatic mammals as well. It was going to be a total disaster. I figured that never happens. It's never as bad as they say. And actually, I bought quite a chunk of BP for personal portfolio. I'm shocked at the size of the dividend.
I actually remember you dialing your broker. So we'll come back to that. We're going to cover it with BP later. So let's go ahead and turn to Cy in Atlanta. And this is one of my favorite moments, presentations that you had done back in the early days, including a cover story for us on traditions. And I guess we can chalk this up to muskrat love, huh?
Absolutely. I remember muskrats well. But that was, I guess, traditions. And what's kind of cool about the preferred procedure is that it became an obsession to me because I joined Better Investing in 84 time frame. I read in the manual about this thing called preferred procedure that nobody did, and I kept wondering, well, why is it really preferred? And so it just struck me very, very odd, and I kept trying to find out what was going on. And then along came somebody named Mark Robertson that said, this is the way to do things, and dug a little deeper and saw, as you see mentioned here, the 1984 manual says that it's really preferred. And then I met Miss Dakota Abbott there, at least virtually, and learned that she was into odd traditions too, of skinning muskrats. And so we talked about that, and really why. In fact, if I recall right, Mark, didn't the original SSG not even include an earnings line?
Yeah, that's correct.
On the front side.
Yeah, some of the work
it was all
now we point that out again.
All sales driven, and then of course you need earnings out 5 years because that's how you build your price. But you know, short of the 5-year out earnings, you don't really need it. Mm-hmm. And so it was kind of a story about going back to our traditions and our roots.
Well, we basically do a preferred procedure on every company at Manifest Investing. So I think it's something important to understand, and I really think it brings a lot of clarity to everything that we do. And with that, I'm going to switch to some of my favorite things over the years, and it goes down to the contributions from all of you. And I look at this chart. What you're looking at is a list of the top 40 by how they'd performed versus the stock market. That's the relative return column on the far right-hand side. Okay, and this is really an awesome list. We basically have 40 stocks. There's another 40 that are within an eyelash of that bottom stock at a 30% advantage to the market, and everybody's on this list. I believe we were talking about LGIH in the green room. There you go. And Cy, I would notice that EPAM has come along and knocked out your cognizance everywhere.
I see that. It used to be Cognizant, and now EPAM has popped up and knocked it out.
But, I mean, from Simulations Plus to Universal Display, there's a couple more Universal Display entries that are just off the screen. But I just love seeing this distribution of names. Hugh's contribution of Ardelyx, who knows where that's going, but it's certainly been good to us. By the way, they were just talking about the presentations like Regeneron and LGI Homes. Cy, you did an EPAM at a national convention. You also did MKS Instruments. There's probably others on here that I'm missing. There's a couple others that, one of my favorites of all time, Hugh McManus and his Amazon. That was presented at a national convention in Chicago, most notably because Hugh presented it and not a single person in the room voted for it. May 16th, Chicago 2014, the $1,000 invested on that day is now worth $10,000.
Yeah.
So
Number 456 came from a convention also, Mark.
which one, Ken?
456 Simulations Plus came from a convention.
Oh, that's right.
I was thinking that. I wasn't sure.
Yeah, I told the story of my student in the mall racing up to
That's
catch me and giving me the Simulations Plus idea. Yeah.
Yep.
So again, from top to bottom, notice that all the contributors are in there, and I do like the fact that, because you guys don't give me enough credit sometimes, I do have a couple entries up there at the top of the list, and I have to be thankful for that. And these are some favorite moments. I gotta love Camping World, Matt Spielman sneaking in there at on the list near the 35 position there. And TJX Companies, one of the oldest selections. Ken, one of your favorites, served this
That's
extreme.
one of my very first choices in, way back in September 2010.
Yep. So with that, let's go ahead and talk about those type of selections lead to this. This is our roundtable performance. We measure the annualized rate of return at 17.3 over the trailing 10 years. The Wilshire 5000 with mirroring investments would check in at 11, so we have a relative return of 6.3. Our objective is to beat that red line, which would be a 5 percentage point better performance than the Wilshire 5000. So we're there. We hope to stay there. These type of numbers are not achieved by everybody, but if you can get near that red line or perhaps exceed it, it can make a substantial difference to your individual or club portfolios over a longer time frame. And it's just awesome to watch this actually cranking away. And we're having some good, clean fun. Any questions or comments on that, Ken?
One of the lessons that I learned, Mark, from this graph and from what we've been doing in the last 10 years is that we sometimes have a difficult time when the market's doing really, really well. And we'll lose 1/10 or 2/10 or even more to the market during periods of real market movement in the up direction. But this portfolio, made up of high quality stocks for the most part, just doesn't have the same downside that the entire market has. And when the market isn't doing as well, that's been the times when we've really made up some ground on this on Mr. Market, and when we've really pushed the graph up much higher above that 5% line. Times when everybody's been complaining that the market was doing nothing, and we haven't had the losses that you can attribute to a lot of things that have been going on. So even in the last couple months, I think that's been true. The market's been on kind of a tear for the last month and a half, 2.5 months, and here we are losing out just a touch to the market. But if you look back in the March, April, May time frame, we really made some good progress versus the market, and I think we've done that every single time that I can think of that the market's taken away. It just doesn't take away as much from this portfolio as it does from the market as a whole.
Yeah, and I think Len Douglas would suggest that we should have used a trailing stop limit order on Apple, and our blue dot would be a little bit higher. All right, so
we always have things to learn, Mark. Always.
Yeah, we do, and that's part of the joy. Thank you, Merlin. All right, just to give it a little more context, and then we'll move on with the program. This is a listing of some of the best performing mutual funds, and there's a single exchange traded fund, the QQQ, in there, and we actually come in 5th on this list over that time frame, and it's actually kind of entertaining to watch those top 3 battle it out for the top position, because every time I look, a different one is in the top slot. We consider all of those funds at the top of the list to be sources of actionable investment studies. So I think this would be a good place to make like December 2015 and do a little toast. I'm clinking my glass. Everybody should take, as Scott Adams would say, a simultaneous sip of the beverage that works for you. Oh, somebody's got a tin cup out there.
Well, this is to you guys and for all the work you've put in over the last 10 years. This program, certainly, we had no anticipation of it lasting this long and having a future. We get good audiences, we get good times with each other, and we demonstrate exactly what it was we were hoping to demonstrate. So cheers, everybody.
Cheers.
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 Cheers. Agus Lancha.
All right. While you guys are all swilling, Al will go ahead and share the current tracking portfolio with the audience.
Mark, I'm going to squeeze in here. Paul has had his hand up for quite a while, so I'm going to see if he has a comment he'd like to make. Paul,
Absolutely.
You are muted on your side, Paul, so if you really do want to speak, you have to unmute, and then we'll make it work. Okay, that probably is an inadvertent hand then, and Paul, I'm going to take down your hand, and I have another Paul that just raised his hand, so this time it's Paul Rom, R-O-M, and Paul, you are self-muted as well, so you'll have to unmute yourself if you want to speak. And he took his hand down as well, so let's keep going, Mark.
It's the professional educator staring down the students. All right. All right, so what you're looking at here is the top 20 by percent of total assets of the companies in the fund. If you want to see the entire tracking portfolio, you can use that blue link up at the top of the page. The way you break this down is anytime we make a decision, whether it's a knight, a damsel, or the audience, we invest $1,000 into that idea. In the case of Microsoft, it's actually been featured, as you can see here, 5 times. So a mere $5,000 is now worth $45,000 in Microsoft. And this is something we might talk about some other time. Microsoft wasn't on that other list, in case you hadn't noticed that. So it got to that level. I know Hugh picked it a couple of times very early in the Roundtable series, but man, just crunching away. So again, any entry on that chart, Cognizant has been the most frequently chosen stock, although EPAM will probably make a run at it if Cy has his way. And 15,000 invested in Cognizant is now worth nearly 23,000. And you just kind of look down the list. Notice that Amazon is a 2-time selection. Very lonely for Hugh McManus, and he seems to be handling that loneliness quite well. Good stuff all the way from top to bottom. Five Below has been a pretty popular stock here in the last couple of years, and of course the Regeneron, thanks to everything that's going on in the biotech sphere. Any comments from anyone?
Here's a quick question. If a stock has been chosen and then we've ultimately sold it out because we've made lots of money, is it in the list or not?
Yeah, it's in the list. You mean on the tracking portfolio?
Yeah.
No, it disappears from the tracking portfolio.
Oh, okay.
It's in that that list that I showed.
Okay.
And it's important to stress too that we do not reinvest the cash in this tracking portfolio. So if anything, we're handicapping ourselves a little bit more.
Yeah, we really are attempting to gauge the results on every single decision, and that's the way it works out. I'll go back a couple slides just to make a point, though. We have invested $559,000 over the last 10 years, and the proceeds of sale actually netted out to a cash flow of $68,000. That's basically what we have in our checkbook. So we still have a portfolio of 360,000. We've taken 920,000 out. So I mean, the numbers just start to get kind of mind-boggling. But we're basically playing with the house's money, if you want to think of it that way, at this point. All right.
Yep.
Let's talk about the hot seat, and then we can move on with the program. There's not much on the hot seat tonight. I would argue that we've done quite a bit of house cleaning lately. 2.6 is the one that comes closest, so we will take a closer look. I think Simulations Plus, just by virtue of nothing else other than that number, probably gets a pass for at least a month or so, at least another update cycle. FedEx might be a bit on the hot seat. We'll see how it looks in a month, but I would argue that we probably need to talk about 2.6 of anything on the chart. I'm going to lobby for exemptions for Schwab because of the status of their big merger, and same thing for Air Lease. With everything that's going on in the industry, they are just extremely volatile. I know Kim follows Air Lease pretty closely. I think they went all the way back up to 40, and now they're back to 25 or something again. It's been a pretty volatile stock.
It's been a great stock to put in a Hail Mary order. We did that on our investment club. We put in an order with no way it was going to hit. We got shares at $20 a share.
Yeah, it's been kind of all over the place. Maybe we take a clear look at that in the near future. So let's take a look at 2.6. 2.6 is
Mark, I'm gonna break in for a second and make it clear to the 3 or 4 folks that are asking me where the money goes. This is all imaginary money, folks. We are not investing real dollars, although I wouldn't have minded if you're looking back on it now. But we are not investing real money, and we're not paying ourselves when we sell something out of the portfolio. This is all imaginary money being handled right now. Go on, Mark.
Okay. It still feels pretty good.
It feels wonderful.
Because, I think a fair point is, when you look at this portfolio, I know for a fact that these companies are well represented in our actual portfolios. I mean, I own half of these companies, and I think that's probably true with many of you guys.
Yes.
So, I mean,
Yeah, maybe not half, but yeah.
Well, that's because you
Even
own
my children.
Lilly and Bristol Myers and Ardelyx.
Yeah.
And United
Scary
Airlines.
for me when Ken talked about hogs earlier. I said, where can I buy that? That sounds great.
I'll send it to you privately, Hugh, okay?
Oh, thank you.
He's probably got a few stock certificates that he's using as coffee holders or something. All right, 2.6, wonderful company featured by Nick Stratigos out of Pittsburgh in his Serious Investment Club a few times. They are in the middle of a mega merger too, transition of the business with the Finisar stuff. So I don't know. They're due for an update at Value Line. We're really only looking at the combination company here, paying a little bit less attention to history. It's had one heck of a run. The stock price less than a month ago was here. It is now here at pretty much an all-time high as it's circling up around $50 a share. This is one that if I was thinking about it for myself in a personal portfolio, I might be tempted to flip a coin and not care if I kept it, but also not care if I took the proceeds from sale and invested it elsewhere and waited for the merger to crank it out. Any thoughts on this one, guys?
Well, I might tip the scales, Mark, by telling you that for the very first time ever, I heard an analyst on television within the week tell me that 2.6 had hit a 52-week high and then recommend that you buy it. So I'm just saying that that's the first time I've heard 2.6 ever mentioned in one of these short spiels where they bring somebody in to tell you 3 or 4 stocks, and he not only did he mention it, but he mentioned it at a 52-week high. So that should be enough there to get us to sell it, I think. I don't know.
Yeah, the one thing I would say about 2.6, since I've brought it a couple of times in the last year, 18 months, though Nick, as you mentioned, is the one who brought it to our attention, was I was kind of buying into some dips and some, market not seeming to take it too seriously and just looking at that price bar. I don't follow it closely. I don't believe I own it personally. So I review it for things like this roundtable and other presentations. But I think Ken just kind of tipped me over as well. But just mentioning that price bar, and the reason I wanted to mention that wasn't just to be a me too, but say that there was a period of time that the company did look like perhaps uncertainty over Finisar. I think there were a few other things going on that the market just didn't seem to really grasp the company, and that's why I was bringing it to the roundtable. And it looks like the market has certainly reacted, if not even perhaps overreacted a little.
Yeah,
on the positive side.
I think it's okay to walk away from them also, and I would just draw everybody's attention to this is the company we've been talking about for years, and notice these two trends along with this price action. I mean, so you talk about the opportunities that were there, and I know people in the audience have taken advantage of that. So I think it's probably okay to add a few more proceeds of sale from 2.6. So we'll go ahead and do that, so we can at least say we're continuing the process, because one of the things we do want to do is get that overall portfolio par. I'm pointing to the average, which is basically around 8 to 8.5%. And we've made considerable progress in the last few months, but we really want to see the average portfolio return forecast restored to at least a 5% advantage to the median stock that's out there. So we continue to make good progress, and it's much better than it was 3, 4, 5 months ago. So we got to keep doing that.
One thing I will mention, Mark, since you're just on that slide, go back to that slide that you were just on, the challenge slide with Simulations Plus. I would think that we want to audit Simulations Plus a little closer next month. Primarily, what jumps out at me there, I like the 17.7 growth that you circled, but look at the number next to it. We're only looking at a 4.7% gain, projected gain, and I'm relying on a 74 PE. That makes me a little nervous.
Agreed. We do need to take a closer look at it, and it's a good subject for our PROVE, right, Ken?
Absolutely, Mark. Mark, we're getting a lot of comments about what's wrong with some of these companies that we're moving away. Right now, the discussion, folks, is centering around valuation. We're not suggesting anything necessarily is wrong with any of these companies. In fact, many times the par moves down to these levels when the stock is doing extremely well. Cognizant's on this list, for example, and it recently broke out from the mid 50s up into the mid 60s now. So it's had a really, really nice move in the last, I don't know, 3 or 4 weeks, I would say, right?
Yes. That's so, about the last 3 weeks.
Yeah, and I've been waiting for that breakout to occur back into the 60s, and it appears that maybe this new CEO from Cognizant has begun to have some staying power and to make himself felt in the company. But again, we're looking at valuation at par values. We're not talking about companies that have something inherently breaking down and causing us to sell because of a breakdown.
I will say there's no truth to the rumor that Cy was sighted running around in the Cognizant building and threatening people.
That was not me. You're correct.
All right. Well, speaking of Cy Lynn, Cy brought us First Financial back in 2016, and we had this one almost made the top 40 list that we were just looking at. And Ken would like to restore it. So take things away, Ken.
Well, this is a Texas bank. I've owned this Texas bank for maybe 8 or 9 years now. You can see by the dark blue on the partial map of Texas where they have their operations. And it's a pretty traditional bank. They call themselves a regional bank, and I certainly think that fits the bill. And regional banks have a lot to do with real estate in their particular regions. That's the traditional banking role that you see filled by a lot of these smaller banks. Again, I've owned this, and some of my investment clubs own this bank as well, so I'm very familiar with it. Next slide. It's basically centered in Abilene, Texas, but they divide themselves into 12 separate regions, and then they run it as 12 independent banks within this region. The oldest of the banks goes back 130 years, and their growth right now is occurring in the Dallas-Fort Worth area and in the Houston area, as you might expect, because the population growth is happening in those areas as well. Next slide, Mark. They have this 12 regions concept where they have a managing director. You might consider him or her to be like the president of the bank. Then they have their own staffs, but they do centralize backroom operations, and that gives them a leg up on a lot of the fixed costs that banks have to incur. All 12 of the regions operate with the same technology and the same compliance officers and a lot of the same backroom staff, so that they can keep their costs at a real low value. Next slide. I was really surprised at this slide in their investor presentation. I did not realize that Texas was in population this close to California. Now, 10 million people is still an awful lot of people. It's still bigger than a few of the states, but I did not realize that Texas had been creeping up on California in population growth the way it has been, and that the population growth had been so robust in Texas at over 20% from 2008 to 2018, where California's population growth was under 10%. Obviously, if this kind of growth continues, we might eventually see these two states vying for most populous in the union, with Florida playing a very strong third in the whole mix. Anyway, a Texas bank is certainly going to have a lot of customers to deal with, especially if they operate throughout most of the state. Next slide. Here's the way that their loan portfolio is structured, and you can see that real estate, 1 to 4 family homes, is about a third of the portfolio. Commercial real estate, a little bit more than a third of the portfolio, and then they have their typical consumer loans, a little tiny bit of agriculture, and then commercial loans. That does include some oil and gas, but oil and gas loans are less than 2% of their portfolio. Next slide. They've had a real strong stock performance, even with the most recent dip in March of 2020. You can see that they've outpaced the NASDAQ, that's in green. And then there's actually 2 graphs down there in the gold color. They kind of are hidden one by the other, but that's graphing the Dow and the S&P 500. And you can see First Financial has certainly been a strong performer in comparison to the NASDAQ and the other indexes that we tend to look at. Next slide.
Is this one of the times when Cy gets to take a bow for buying it low and selling it high?
Cy certainly should take a bow for buying low and selling high. I think a lot of us are beginning to understand that principle and apply it on a regular basis.
He'll get another chance in a minute.
We're listening to Hugh with buying like Spock and selling like Spock, rather than relying on Captain Kirk. Okay. I like it when any company that I'm studying sets me a list of what they're going to try to do in the future. And in the near future, First Financial has set a list of 7 things here that they're going to make an attempt to do to keep things moving forward. They're concrete things, and what I've done 2 or 3 times in my years of owning First Financial is I've gone back and looked at their promises, and then I've asked myself, how have they done? So this will be a nice exercise for 2021. How have they done for 2020 when the fiscal year is over. And they've told me exactly where to look, so that's what I'll be doing. Next slide. Here's the lines, and you'll notice there's a fourth line in the visual analysis for First Financial. We still have our sales line in green and our pre-tax profit line in the pink or the magenta, and we have our earnings per share line in the darker blue, but in that aqua or teal color right there, that's assets. And I've listened quite carefully to the folks in Better Investing that are experts on banks, and they've told me that the best thing I can watch to gauge how well a bank is doing is watch their assets. And when the assets are growing, the bank is doing well. And when the assets are declining, that's a warning signal for me to look at when I'm trying to study what's going on. First Financial certainly had asset growth in the first quarter of the fiscal year, and I'll be waiting to see if that asset growth continues into the future quarters for this year. The bank is doing extremely well when you think about COVID and everything else. And they did a presentation less than 2 weeks ago trying to make the case that less than 5% of their total portfolio of assets is exposed directly to COVID sensitive kinds of stocks. And that would be things like restaurants or travel, any kind of luxury items, that kind of thing. So we'll see, but the asset growth in the first quarter was certainly kind of strong. Next slide, Mark. Our tools, the SSG Plus tools, also give me some extra lines to look at when I'm looking at a bank. And you'll notice there's 4 lines rather than the standard 3. So that fourth line is just a rehash of that aqua line that I saw on the graph. I'd love to see those assets growing as quickly as the sales, or about the same as the earnings or the pre-tax profit. And you check all 4 numbers in the growth column, and you'll notice they're pretty tightly bunched around a 9, 9.5, 10%. That's parallel enough for my tastes. Also looking at the return on average assets. Our bank examiner has taught a number of classes for us on various Better Investing webinars, and he's made it clear that if you can maintain an ROAA, return on average assets, of 0.85 or above, you're doing about average for a bank. If you can move those return on average assets up to 1.25, you're doing a really good job as a bank. And if you can move that return on average assets up to 1.5 or above, you're doing a superb, an exemplary job. And you can notice that for this bank, going way back to 2010, their ROAA has stayed at 1.5 or above. And the 5-year average, the most recent 5 years, is just a touch under 1.8%. So I'm exhibiting all the things that I would want to see for a quality bank. In addition, I'm looking at the quality rating itself in the Chronicle. That's that blue line there in the graphical portion. And the quality has stayed nice and consistent, up near 100 in the high 90s. And I'm looking at this bank at a historic time when I'm buying at a par that is perhaps higher than the par has been over the past number of years, past 4 or 5 years. Now, that par value has come down a little bit. That data point is from the end of June. So we'll be getting a new data point for the end of July, but the data point for the end of July you're going to see is still pretty decent. Next slide. If I use PEs of 30 at the high average and 20 at the low average, suggest a payout ratio of a little bit more than 40%. And if the stock is selling at $30.56, which is where it's selling right now, that will generate a par for my numbers somewhere between 11, not a par, generate a return somewhere between 11 and 15%. Mark's figures coming from the analyst community is a little bit more robust. He's generating or showing a par right now of just under 19%. I will take my numbers and be very happy if the analyst community is correct with Mark's numbers at 17, 18, 19%. All in all, I think it's a nice time to buy a bank. They're loathed right now by the investing community, especially by retail investors. So I'm going to suggest we take a position in First Financial, FFIN.
All right, thanks, Ken. Yeah, one note about the banks, the analysts, the consensus of the analysts has been pretty optimistic on forward-looking return on equity. And that's been moderating a little bit in some of the updates that we've been doing. So just something to keep in mind. All right, we'll turn it over to Cy, and he's going to bring AbbVie back to the portfolio.
Yes. I don't know exactly. This is a stock that's, I think of two of our knights and damsels. I cringe touching a pharmaceutical with Hugh in the room. So that's kind of my fear factor. And although AbbVie is 7 years into its history as a company, but I also think of our buy spinoffs queen in Kim Butcher here. So
Yeah.
I guess that's that's my non-fear factor on AbbVie. I don't personally own it. I have owned AbbVie in the past, as has the portfolio. You can see here consistent sales. These are Morningstar as reported numbers on the pre-tax and earnings line. A reasonably steady uptrend, but if you exclude extraordinary items using value line numbers, you'll see those are also a bit straighter. Basically, adjustments being made because of it being a spinoff and then some acquisitions and the like. It's got a lot of extraordinary items, especially in the last 2 years, 18 and 19. You see right now, Value Line has it as a good safe pick, average safety, but a 3 is a good safety rating, which is based on financial strength as well as some momentum and price factors and earnings predictability. So it's a little bit more than just financial strength, but it's a good, solid company. Timely pick, which we don't look at greatly, but I'll always take it if I can get it. But notice what I am attracted to is the long range Value Line projection on the low side of 12% and potentially high of 22. So again, in today's market, I'm pretty happy with those as nice initial figures. Let's dig a little deeper. I was screening for a new company this time. You could see the criteria. I was a little below the blue par zone in the upper right-hand corner of 13% when I did this yesterday, I believe. I think it may have been using, let's see, today's Tuesday. Yeah, it was probably using Friday's closing prices and so forth. Quality of excellent at 80 and an 80 financial strength. I decided since Ken keeps pushing us, and I agree, let's nudge growth a bit. I decided to rank my results by growth, in particular, since as is normal right now in today's market, these screens give us a lot of financial companies, although you see some mixture in these ranked by growth. But if you just rank by return, it's heavily financial. And I got AbbVie is right in there. The numbers I like, the relatively low PE necessary for it, the relatively high yield. I don't pay a lot of attention to yield normally, but if it's there along with good growth and good potential return, it's a nice plus. And notice that financial strength of 93. That's going to become somewhat important as we get into the presentation. Next slide. Just a quick industry study. Here's drug manufacturers ranked by par. And you see that AbbVie is among the highest quality companies. I usually rank this slide by quality, but I didn't for some reason in this case. But you still get the picture. You can see it's by far the highest excellent quality company with potential return. And again, good growth, good yield. Next slide. This is just off the side of the AbbVie Eagle, the manifest projections for that. And it just gives you, again, a quick snapshot in the manufacturers. You see AbbVie is the top, and that's based on a combination ranking, the manifest rank of quality and par. And it's also well up there in the healthcare sector. Next slide. So just kind of quick reinforcements of the screen, or what those last couple are. So who is AbbVie? It's a big biopharma, big company. They operate in 75 companies. As I mentioned, they were spun off from Abbott about 7 years ago. They focus on immunology, oncology, virology, and neuroscience. Key drugs that you may be familiar with there are Humira, which is their main drug right now. Over half their revenues, at least pre-merger with Allergan, was that high. It's probably going to be below half now, but Skyrizi and Rinvoq came out in the last couple of years and are high growth areas, and we'll see a little bit more about them. They just added Allergan and the Botox franchise, Allergan itself being a spinoff probably about 15, 20 years ago. And if you want to see detail on the pipeline and where all the drugs that they have are in the FDA process, there's a real good website. On their website, they have a good link where you can just scroll down and see what's going on with the drugs and what sorts of diseases and conditions they're aimed at. Next slide. Here, again, this is from a presentation by the company. Again, just mentioning some of the recently approved drugs. I mentioned Skyrizi and Rinvoq. And you see here, one of their strategies is to have an indication that is approved, that is a condition that the FDA gives approval for, and then to look for FDA approval in other areas, but also understand that doctors can prescribe any approved drug for non-approved areas if they're convinced that the research is good enough that they're comfortable doing it. It's called off-label prescribing, but in this case, AbbVie is seeking to have their drugs approved for other indications, and you can see basically in this slide that they think they could add about $3 billion in revenues from these drugs by moving into these other areas. Next slide. This is just the next step. Moving from the approved indications into related areas, and then they've given a couple of their phase 3. I believe most of these are in related type of treatments, and then just kind of a quick summary there in the last column of where they expect some of their drugs to be moving into potential approval. So this is a snapshot of their pipeline. Next slide. I mentioned look at the 93 financial strength rating. One thing that will jump out at you big time when you look at AbbVie is it's got $67 billion in debt. That's actually 100% of the capital. I haven't dug in depth to try and figure it all out. I suspect some of that goes back even to the spinoff, because it's had a pretty high debt level, even going back there, and low equity, although some things have happened in the last 4 or 5 years. But again, I trust the analysts that dig in. Value Line gives it an A financial, but notice, yeah, there we go. The third line, it may have 67 billion in debt, but look at how much cash it has. 41. So significant chunk of its debt is covered by cash. So again, it's there, but AbbVie, particularly with the addition of Allergan, is a cash flow machine, and they're able to pour a lot of that into research and development, and down the road, perhaps into assets on the balance sheet. Next slide. Here are my judgments: a 12% growth rate, about a 28% net margin. Those are roughly in line with the manifest consensus. The PE is a little difficult to compare using Better Investing data feed, which is Morningstar numbers, versus some of the Value Line based numbers because of the extraordinary items. Value Line gives you a much lower projected PE, though again, I think we need to look toward the lower PE because again, going forward, presumably there will be less extraordinary items. So you want to look a little bit at that. So I tweaked the PE down, projections down a little bit in my projections. I think, let's see, a high PE of 19 and a low of 14 and a low of 10 for an average of 14 and a half. And I get a 17% average return. I think manifest, if I recall right, when this was done from my earlier slides, was about 16 and a half. So it comes in about the same, though we get there a little bit different places. I have a little bit higher PE and a little bit lower margin, but the consensus uses a little bit lower PE and a little bit higher margin. So I think it's a good prospect.
Nice to see the preferred procedure laid out there. All right. Thanks, Cy. All right. If we can shoot for 10 minutes or so on these, I might condense mine or skip it for next month. So let's try to move things along. Go ahead, Kim, with Cardtronics.
Okay. I have been doing these stock presentations lately, and I've been trying to find stocks that's something new for us and how it's been impacted by COVID. Well, Cardtronics fits it immensely. They happen to be the largest ATM operator. Well, think about how we get our cash and New York City is shut down and no one's going to the money mover to get any money. So this is a stock I have found, and at the end of the presentation, you'll find out why. It really was kind of interesting for me. As this says, they are the largest ATM operator, and they've got lots of scale, a lot of networking of a moat, and they like to have convenience for the consumer, and it's around the world and across the continent. So next slide, please. With that global presence, they have 285,000 ATMs across 4 continents, and this is a small cap. They're in Canada, the US, Mexico, UK, Ireland, Spain, Germany, South Africa, and Australia. And as I was researching this company, I found all kinds of interesting stuff. Next slide. Now, they have this great network with a lot of products and solutions. So they have this all point. So sometimes when you go to a money mover, you can only be within one system. Well, they have a system that lets you go across. Doesn't matter where your money's at, you can go across all points. There you go. They've got a lot of partners internationally and local, as you can see, with Fifth Third Bank, local, and USAA, PNC Bank, Capital One, US Bank, and Bank of Santander, which is out there in Spain. And Walgreens, they have these money mover machines in Walgreens, Speedway, And it's one of those things to consider is when the COVID came, everybody stayed at home, but if you needed money, the bank was shut. If you needed cash. So this is a company that also serves those underserved people who are working the lower income jobs and work on cash. How are they going to get cash to pay their bills? And next slide. You can see how they've got a diverse revenue stream by the segment between North America, Europe, and Australia, New Zealand, where their sources. They have lots of ATMs that they own themselves, but there's lots of merchants that they want Cardtronics to manage for them, because ultimately banks are looking to probably lower their footprint because they're finding out so many banks were closed, and they were able to have, they could have less expenses with less employees. And this can, how it can affect the banks to be as profitable as they want to. Next slide. So with having different revenue sources with the ATMs, you can have a transaction from an outside bank that goes to your network. So there's a surcharge. You have an international customer who wants money from that local country for that local currency because they want to use something like that. And they have things in the UK, they have a convenience fee. But they also have been developing a surcharge free, and it's branded with Cardtronics so that those customers who need something, they don't have to pay a fee. Well, that makes people much more happy. And some of these ATMs that they have, I have read that within 85% of the population will find within, I think it was 10 miles, they will find an ATM where they can get cash. And I'll get to why cash is important. Next, there you go. Through the COVID, what they had in their last presentation is, believe it or not, I didn't even realize this was happening. Banks are changing in that banks are wanting to close down some of their branches. Why? Because it's less of a cost, and what they want to do is they are going to save more money. And that's the whole thing, saving money of lowering their costs. And what they do by using the infrastructure, they're using their Cardtronics ATM because people can maybe be able to deposit money by their phone. They can check their balance by their phone, but they can't get cash out of their phone. So using that infrastructure that they have some that you could do for a fee and some that is free for in the network. And they have the software to be able to process all those transactions. And actually you can go to the ATM if you got, if you're a 16-year-old and you were cutting grasses, you could put the cash in. So this is the thing that the ATM is able to help because it's the central point for all of it. The pandemic said that it showed them how the strength and resiliency of the ATM network, because of that geographic distribution of the footprint of the ATMs. And it provides such a service because you do have those people who don't use credit cards. Next slide. I found this in one of my articles that I was researching the company, and I would have never guessed that this many bank branches have been closed. And if you look at it, US Bank has closed 69, Wells Fargo has closed 63. Old National Bank is where I'm in Evansville, Indiana. That's where the home is, that is 31. Fifth Third is in Evansville, 29. I didn't realize that banks were closing some of their different banks. You know, some of them going forward. And by having less banks, they have less tellers, they have less bills for overhead that they have to pay, so it's more profitable for them. Next slide. This is one from an article I found, and some of these articles that I found I'm going to send off to Mark so he can post it on the site. But a Pittsburgh bank added an online tool allowing customers to make appointments with a banker, and they took away some of those tellers that they had. They never imagined that the bank went from 21 appointments in January to over 2,700 in April. Think about that. 21 appointments to 2,700 in April. That is where going to the ATM is going to also be able to have you be able to set up appointments for all this. So this is like the central location is the ATM to be able to get cash if you need it, taken out, cash if you need to deposit it. You can find out a balance on your account of what you've got there. And as Ken talks about a disruptive technology, I never would have thought that bank branches would be closing. So next slide. They're also moving forward that they're putting a lot of these ATMs into retail areas, as you saw that slide, like in Walgreens and Speedway gas stations and all. And your phone, you could, with the ATM, it's a physical gateway for converting your digital balance. My balance says I have $500 in the bank, so I can go to the ATM and I can get 25 bucks out to get gas and get something else, and there you go. So you can go back and forth from deposits to cash and back to digital. Next slide. This is a slide I took off of stock charts, and I want you to notice how back in March, you can see where the stock price was going down, hit a bottom in April, and it's been going back and forth since, but the stock has a RSI of 47, so it's not way overpriced. The stock price is in the low 20s. And if this was a $40 stock when the economy was booming, there's no reason why this stock shouldn't be another $40 stock. And it's in the low 20s. Next slide. Now, I looked at the P&F charts, and as you can see, I got this off today as I did the presentation. This is also from stock charts where it says they're having a low pole reversal. And notice where in red where you see 2269 when I grabbed it off the stock charts page, that at the time was the stock price when it closed. And basically a low pole reversal, and I'm learning this just like the rest of you, it's a pattern to alert that the higher prices could, I'm not saying it will, could be seen in the future, like it's reached its bottom and it's consolidating now. And I'm hoping, anticipating it's going to go back up, because if the economy was booming, let's say in a year, we've got this pandemic behind us, the stock should easily be able to go up. Next slide. I took this off of E-Trade. Here's the average price target. If it goes from the low 20s to 33.50, that's an average of about a 47% upside. I'm not going to be complaining if I get a 40+ return in a year. Next slide. And here you go. By putting in the numbers from what the current price was, what I expect for sales growth, what the net margin is, shares outstanding, average PE, I got a potential annual return of 18.3. Not too shabby. So I believe, Mark, that's my last slide.
All right.
All right, there you go. I hope you guys will consider, there you go.
Oh, some insiders also buying that you wanted to point out, but let's go ahead and move on with Hugh. And Hugh's going to go into his loathing basket.
Yes. So I'll move through these slides. There's a lot of them, but I can move through
Okay.
quickly. You can hear me okay?
Yes, you're doing fine, Hugh.
Okie doke. So the company I've selected is DP. I go through the same process every month. Ideally, I like to add some of the portfolio that I've owned before, but BP just jumped out of me recently, mainly because of the dividend yield, which is a huge red flag, as we'll talk about in a second. But it made me look further, obviously, because there are concerns with this company as there are with the oil industry. So skipping along, a little bit about BP. It's over 100 years old, a British company, founded just before tax day, which tax day would have been 8 years old back then. I think it came in 1901 or 1903. And 1% of the population paid 1% of their salary in taxes. And we were promised that wouldn't change much in the future. So glad that promise was kept. It's a multinational oil and gas company. It's listed on the New York Stock Exchange as a depository receipt. Trades on the London Stock Exchange. You'll see its revenues all over the place because they are reported in British pounds, and then depending on the exchange rate, described in US dollars. But it has a narrow profit margin, quite a good free cash flow, and the stock price currently at 23 puts the dividend into a very scary yield of about just over 10%. It was 16% a few months ago when the big dip happened. So moving on to the next slide, some, I think, highlights on BP. It has a strong and relatively stable cash flow, despite all of the vagaries that there are in the oil industry. A lot of debt compared to its peers, but very highly rated, so that's good. And management reports that it is spending aggressively to increase output and also to increase cash flow, they believe, by 40% annually for the foreseeable future. That's not a compounded growth, that's aggregate. And that actually happened before the COVID incident really took hold. And when that happened, of course, revenues, profits particularly, were damaged a lot by 67%. But they've been buying back shares, almost $750 million worth of shares last year. So skipping along, clearly, SARS-CoV-2, that virus, has wreaked havoc in the global economy, and let's take advantage of that if we can. Energy producers, particularly those in the oil sector, have been singularly badly hit. Consumption has dropped, people aren't driving, etc. Oil has been stored everywhere there's a safe place to put it, because production just continues. It's a capital-intensive industry. They just keep going. But consumption, fingers crossed, should bounce back. I think most rational people would expect it to happen. So if we move on to the next slide, you can see projections from an agency which you may or may not have heard of, the Energy Information Administration, part of the US government. Great website, provides lots of information on many energy sources, both in the US and globally, and it's the go-to place for many analysts, all free, of course. And you can see what happened recently with the dip in the darker line. That's world consumption of oil has drastically dropped, and whereas production has dropped only marginally, or it has dropped significantly, but not as badly as production. But there's two take-home lessons for me for this. First of all, the forecast next year looks pretty impressive, where consumption will way outstrip production, and I would expect a severe spike in oil prices next year if this comes to pass, this forecast. And the reason I would like you to look at that is if you go back to 2015, 2016, when a very similar thing happened, there was production, and it looks very slight over on the left. Production and consumption got out of whack. We'll see later what happened to the price of oil when that slight difference occurred. So let's skip on to the next slide. This sure is a comfort if you're investing in oil, because the fact is that even though consumption as a percent of energy usage is dropping, consumption of oil has been growing fairly steadily. You can see slight dips when there's a recession, but it's growing by about 1 million barrels per day globally. We're now close to about 100 million barrels per day. The US is now only 20% of that number. It used to be close to 25, and in the 50s, 33% of the total oil consumption. And the next slide is interesting because even though there's been a lot of discovery, you can see that proven oil reserves are steady. Hasn't been growing at all, not like it was 50s, 60s, and 70s where it was growing by leaps and bounds. So on the next slide, we can look at the share of energy among different generating sources, including renewables, hydro, nuclear, coal, gas, and oil, all in the big green thing in the bottom. It looks to be growing, as does natural gas and coal, But I think if we go on to the next slide, it's a bit more telling. This is the numbers on the slide you just saw. A bit of an eyesore, but this shows a much more interesting picture where you can see that oil is actually declining. Even though it's growing about 1 million barrels a day in terms of overall consumption, it is declining as a percent of total energy usage. Coal has peaked a few years ago and is declining, but right down at the bottom, I'll call it burnt orange for people in Texas, you can see that renewables has been steadily increasing over the past 25 years and growing actually quite dramatically over the last 10 or 20 or so. Nuclear, one of my favorites, unfortunately, has been in decline. Natural gas, not surprisingly, used in power plants for electrical generation, etc., is on a steady growth. And if we skip along to the next slide, this echoes back to what I talked about before. The dark green line is kind of real currency, real dollars, and the lighter green line is inflation adjusted. But what you're looking at here is the price of oil over time. And this dates back to 1861. So oil was first taken from the ground aggressively in Western Pennsylvania through today. And I mentioned, if you look at the far right, 2010 to 2019, when production and consumption got out of whack a little bit, you can see how that dramatically impacts the price. Production and consumption are very, very finely balanced. And when they go out of whack, prices go haywire in the oil industry. And we all run around with a hair on fire screaming the war is coming to an end. It never is, but it provides great opportunities for buying in this industry, and for that matter, for selling as well. BP, for me, would not be a core holding. So let's skip along. So going forward, things will recover and oil consumption will continue to grow. Won't be as big a percent of the overall energy usage, but it will continue to grow. And I talked about the red flag in the dividend. It's got a very high yield, a scarily high yield, but BP has always had a very high yield. It isn't taxed in the US, at least there isn't withholding tax from Britain because it's a UK-based company. So I think there's a small transaction fee, but by and large, you get to keep all that dividend, get some of it to Uncle Sam at the end of each tax year. But you don't have to pay Her Majesty anything, so that's nice of her. But will it cut the dividend? I'm banking that it will. Shell recently cut its dividend in May after 75 years of dividend stability. And that was a dramatic event, but it did not impact the stock price of BP overall. And for that was a signal to me that the dividend cut is already baked into that price. So it gave me comfort to buy it. And the price drop has been much worse. If you remember the headlines 10 years ago when BP was spilling oil into the Gulf of Mexico during the Deepwater Horizon debacle, people were forecasting this company was going to end. And if we go on to the next few charts, you can actually see how the price has varied over time. It doesn't include Deepwater Horizon. I'll show you that in a second, but you can see how dramatically the price of BP has dropped recently during the COVID-19 disaster. The next slide shows, I think, 35 years of history. And there you can scan back to 2010. And if we'll move on to the next slide. But if you scan back to 2010, you can see that, yes, that was an existential threat for BP. Everyone was predicting that the company was going to be totally destroyed. You see that huge spike in volume there. And the price dropped. It certainly dropped by then, it seemed dramatically, but it actually dropped by 50% or so. But it has dropped even more dramatically today. The energy sector overall has done that. And then I've just looked at British Petroleum, as it used to be called. I'm not going to have it of saying that on Manifest Investing. A lot of interesting information, much slightly higher dividend yield here. No, it's not a dividend return, excuse me. It has a dividend yield of 4.8%. That's a miscalculation. It is a bit higher. But it has a dramatic par, projected annual return of 13.5%. It could be higher, actually, if oil prices rebound the way the Energy Information Agency is projecting. Let's see. Let's wait and see. And you can see the sales are slightly different. It depends on when you actually do your currency conversion calculation. The company the financial strength doesn't look good, but if you compare it to its peers, which is a key thing to do, it doesn't look bad in comparison to its peers. Bad earnings per share stability, but that's to be predicted based on what we talked about. Price going all over the place in this industry. skipping along, I think this would be the last slide. I'm just wrapping up by saying that I'm going to add DP to the portfolio. It seems to be a car wreck in slow motion, but when you look at the broader macro information surrounding energy, you know it's not going to go away. You know it's going to bounce back. And the only threat here, I think, is with the dividend, and even that seems to be baked into the price. So that's why I'm keen on adding, being very ecumenical here and adding a British company to the portfolio.
Okay. Very nice. Thank you, Hugh. All right. Well, Ken, what do you think? I've got 9:57. Can I do a 5-minute version perhaps, or do you want me to defer till next month?
Why don't you just finish it out, Mark?
Okay. Well, just real quickly, this is I'll leave this for the audience to dig into a little bit deeper. If you take a look at the slides, a couple of things to notice. What I've done is ranked companies by their manifest rank, which means they have a high projected return and a high quality rating in general. Notice, as Cy was saying a few minutes ago, the number of asset-based companies that have floated to the top. Also recall that I mentioned that many of them are probably going to see return on equities subside a little bit. Notice that Ken's First Financial is the #1 entry on the chart. It was tempting to me. In fact, I thought about doing a horse race between it and Bank First Corp of Oklahoma. They're both respected banks down in that area of the country, and they're assigned bailout of other companies because they are good at what they do. And there are a couple other companies on here that draw my attention. Much like a stock comparison guide, I do like to go in and circle the more attractive ones on here. I'm drawn to British American Tobacco, although I can't stand cigarettes, so I kind of overlooked that one, although I did select British American Tobacco at the National Convention a couple years ago. Did very well for a while, and now it's kind of smoked out. Iteran location, I'll just encourage you to do a little bit more homework on the stewardship of that company, and I would have a real hard time with some of the numbers that I'm seeing there. So I was having a hard time warming up to any of these, believe it or not. There are some good shopping opportunities. I do think we need to talk more about Air Lease in the future. Limonera is a company that I featured last year that is now actually pretty attractively priced after the pretty solid price drop. But I do want to draw your attention to this. I'm always watching for articles like this, especially some fairly newer names that I can sink my teeth into. And the one that kind of floated to the top of this search was Globant, ticker symbol GLOB. And one of the reasons I wanted to go here is this is a company that does do quite a bit with artificial intelligence. And I'd also like to begin shopping a little bit more diligently. I mean, I had Roche Holdings from years ago, and there's been a few companies that are from outside the United States in the portfolio. But I think over time, notice the number of outperforming stocks that are foreign in nature, over the years. So there's got to be a field of opportunity there. And then when you look at how poorly they've done during the global recession, which seems like it's never ending, they basically been underperforming for 6 of the last 7 years. So I think there could be opportunity out there. Perhaps Hugh's right with his British selection of BP. So who are these guys? I do like the fact that they're international, ex-US. They do a fair amount of business in the United States, but they are domiciled in Luxembourg. They get credit and points for working in artificial intelligence. I do think that they are doing some efforts in blockchain. I owe you some research on that. And I was impressed by their growth rates, their recognition by some fairly respected places like Harvard and Stanford. They've had dramatic growth in employees. They seem to be hiring a lot of women, especially a higher percentage of women than their peers at the upper echelons. Just a lot of stuff here that's kind of compelling. This is a real nice roll call of companies that they do business with. Again, they deal with a lot of domestic companies, but they are spending an awful lot of time in South America. And this is a very high quality list of companies. AAP's great utility. Unilever, one of the best consumer companies. Of course, American Express. How about those guys out of Atlanta? They do 55% of their business overseas. How about this one? A Roundtable favorite from a long time ago, Mercado Libre. Southwest Airlines. So these guys are used and respected by many of the companies that have drawn our attention over the years. I like that. Here's what it looks like. Again, it's I would classify this as kind of early with more research required, but how do you top that top line? And notice that the up straight and parallel is a pretty good work in progress over the last several years. The problem I have is I didn't present this a month ago. A month ago it was at 85. It is now at 170. So they literally have gone in the span of the last quarter from the bottom of that price bar to that all-time high. So they might be getting a little bit frisky. Very high growth stock, higher PE. Who knows where the margins are going? The industry average is somewhere in that 16 to 18% range. It's feasible that they will get there. So I'm looking at a company that I wish I'd have looked at a month ago, but I kind of want it to be on the radar screen. I think we're getting in at a decent price, but I would watch for accumulation opportunities in the future because those lines are pretty. And once we have them on the radar screen, perhaps we can accumulate over time. But again, a 15 to 16% projected annual return with some fairly modest assumptions, decent projected return on value, not great, but decent. And again, like I said, I'd like to have found it a month ago, but we will add it and track it going forward. With that, Ken, let's go ahead and do the poll.
Okay, if you give me just a moment, Mark.
Yeah.
And here we are, folks.
And Si, you have my permission to dig in a little bit deeper and do some comparisons between EPAM and Globant, and maybe we can have a cage match in the future or something.
Sounds like a winner to me, Mark.
They have impressive materials. If you look at their investor relations stuff and learn a little bit more about the company, it's an interesting work in progress. I'd be interested
They
to
do
hear.
look.
Go ahead, Si.
I was just going to say they do look interesting, and as you know from my presentations on most recently EPAM, to some extent Cognizant going back, it's nice to look at who their clients are, which you did. So.
Yeah, I'd like to hear from Pat Donnelly on that one because he works in that realm.
Right.
As far as I know, they've not done any work for Fiat Chrysler, so I didn't have that to lean on.
Mark, I'm going to close the poll and share the results. And looks like this time we're going to add a second holding of First Financial Bank Corp, FFIN. Okay.
Very good.
Pretty tight race between AbbVie and Cardtronics.
All good companies. All right. Time to do some filling in of dates. August 25th for the next roundtable in August. Ken, do you have a September date?
For the roundtable, Mark?
Yeah.
It'll be the last.
29th.
Okay, that's it. Yep.
All right. We miss you guys. We generally get out and about and spend some time in places like Cincinnati, Indianapolis, Dallas, where some Philadelphia. We feel like we really would like to be out there face to face, and hopefully that will begin to happen as soon as possible.
Mark, if you'll put this back on show mode, that would help.
Okay. Now that I made my editing repairs, huh?
There we are. Okay.
So I just wanted to point out that we'll continue to do these type of things. Ken and I will be doing a broadcast for Northeast Ohio and Cleveland in September. But we are going to do more of these type of sessions. The bull sessions go on Tuesdays at 2. You can find out more information about those at the Manifest Investing site. We are doing some interesting exploration of the projected return on value concept, which I think is going to be additive and complementary to traditional stock analysis that we've always done. So we'll have some fun with that. And
Mark, I'm sorry. Go on, finish.
And I was just going to say, the Mid-Michigan Stock Pickers Breakfast, I guess we just fold our hands and pray that we'll be able to at least socially distance some Michigan.
That's just what I was going to break in about. We are in negotiations with our venue right now, but it looks like that might end up being remote as well. If it is remote, it might turn into the Mid-Michigan Stock Pickers Brunch, and we might advertise it to our whole audience and allow them to come and listen to what we do on a regular basis and have been doing for 16 years. So we're going to cross our fingers and hope we can meet face to face, but we're negotiating about that right now.
Well, maybe we turn that into a mini COVID cancellation conference or something.
Well,
Thanksgiving. Hey, why not? I mean, you guys are awesome. You can figure that out.
We'll just have to see, okay?
Okay. All right, and with that, I'll just close with a great big thank you all.
Yes, we'd like to thank everybody for coming this evening. And Mark, the question box is pretty clear. We have some relatively technical questions that you might want to review at your leisure, but for the most part, we're clear. And thanks to all for all you do, and especially for the last 10 years, Cy and Hugh. You guys are real troopers. And Mark, you know that we couldn't do a lot of this without your consistent support and encouragement and everything else. So thank you as well.
Well, you're most welcome.
Our pleasure. And thanks to the audience, and happy anniversary, everybody.
Good night, all.
Yeah, thanks all. Bye.
I'm taking a class again. Everybody should be taking another step.
I'm down to my olives, Mark. Okay.
Okay, well, chew on those olives, Ken.
I'm going to. I'm gonna end the session now. Good night, everybody.
Thank you.